Hey guys, what's going on? It's your favorite mortgage lender, Abdel Khawatmi, Paramount Residential Mortgage Group. Now, before I actually start getting into a little bit of the details of what's going on in the market, I would highly recommend everybody to really take a second of their time to truly watch some of the facts I'm going to be sharing with us and some of the things of what's been going on in reference to interest rates and, most importantly, the real estate market. So the first thing that I want to touch base on is that it's important to remember that the Federal Reserve had began buying these treasuries and mortgage-backed securities around in 2020 during the heart of the pandemic. They did this in an effort to stabilize the economy and the market. Now, inflation, obviously, as most of us are aware, really heated up, and the Fed had no choice but to actually start purchasing and slowing down a little bit of their mortgage-backed security bonds, which has greatly caused a little bit of this change in the market that we're starting to see. Thereafter, roughly towards the end of last year, they announced that they were going to start tapering. Tapering basically means that they're going to reduce back buying mortgage bonds. Once they actually just completed their tapering, they're no longer buying outright. They're still buying almost $3.8 billion in mortgage bonds through investments, but now their balance sheet is allowing mortgage bonds to fall off. Now, the yield spread between the 10-year Treasury and the 20-year Treasury is something that we want to keep an eye on. When we're putting away our money for 10 years versus 2 years, you would expect a higher rate of return. But during an economic slowdown and really the fear within the market, it's actually been inverted. It's the opposite, which means that putting your money away for 2 years actually gives you a higher rate of return than 10-year, which is basically upside down. Now, looking at that fear of recession, this is almost always happens. It happens right away. It takes about a year or two for the actual recession to occur, but we're starting to see it. Now, when the Fed hikes their federal funds rate, it causes the short term to yield and rise, which now makes interest rates rise. Now, remember, the Federal Reserve hiked their benchmark Fed funds rate by almost 25 basis points in March. They're expected to do another 6 additional hikes, with almost 50 basis points jumping up in May. This spread, when they do that, should probably narrow the 10-year and 2-year Treasury, which is going to likely, again, create a recession indicator. Now, recession is not necessarily the worst thing for an economy. One of the good things is when we do go into a recession, they're usually coupled with lower interest rates. So really interesting to see within this month, into next month, and really into the rest of 2022, what is going to happen in reference to interest rates, the market. If interest rates go up, will market prices stabilize, or are we going to continuously start seeing a level of approach where we'll meet in the median? Again, guys, Abdel Khawatmi, Paramount Residential Mortgage Group. Give me a call directly, 201-679-0422, and we'll discuss any questions that you have. Thanks, guys, and I'll catch you guys next time.